Hello, my name is John Burke. I'm a lecturer at RISEBA University, and I will be your course instructor for international banking. I'm going to make a series of recorded lectures like this one. I will try to make them not too long because I realize that it involves difficulties of attention span. So in today's short lecture, what I'm going to do is give you an overall view of the course. So the course materials are already on the RISEBA website. I will have short videos like this plus short assignments so that I can make sure and assess your learning, whether you're learning the outcomes or not. So what will be the basic learning objectives? Well, first I want to give you an overview of what you might call the international monetary system. And not just the international monetary system, but also what I will refer to as a three-tier structure. So we have the fundamental financial institutions that constitute the international monetary system that banks operate in today. Then, of course, you have governments, central banks, and commercial banks. These are incredibly important actors. And then, of course, we have non-bank financial institutions and markets of various types that are also involved in the provision of financial services across the world. Second, I want you to understand what is a commercial bank. A commercial bank is a very peculiar type of financial institution because it has the ability to create money in a similar way as a central bank has the ability to create money and expand or contract the money supply. One of the instruments that the central bank uses to increase or decrease this quantity of money in a particular economy is to use commercial bank reserves held at the central bank to give guidance to the activities of commercial banks. I want you also to understand what is international banking. International banking is simply banking that crosses borders. So we are going to focus primarily on payment systems. So how are international payments made? We are also going to focus on lending, so debt financing that crosses borders. We are not going to focus on what is sometimes called shadow banking. That is when a bank takes advantage of a jurisdiction with relaxed rules in order to operate and provide certain services and products to particular clients in different locations. I'm not going to focus upon that. The other thing that we will study in this course is we will take sample financial statements from a large bank because financial statements actually show you what a bank does. So it will show you what are its assets, what are its liabilities, where does it invest its money, what exactly is the bank doing, how much capital does the bank have in ownership equity to absorb losses. We're also going to talk about risk management. How does a bank manage its risks? Because the bank's primary problem is that it has short-term liabilities, meaning, an example, customers make a deposit with the bank in a current account, and let's assume it's a demand deposit account. That money can be withdrawn at any time without prior notice to the bank, while the bank's assets, which are generally loans or other types of investments, are long-term. So we have a maturity mismatch, and we'll see how banks tend to mitigate the volatility or the risks that are involved from this maturity mismatch. So that is an overview of the course. So what I want to do today is at least identify the basic institutions, I call them the fundamental institutions that make up the infrastructure of the global financial system. And these institutions are the International Monetary Fund, the World Bank, that used to be called the International Bank for Reconstruction and Development, SWIFT, which is a message protocol system to facilitate international payments, the Bank for International Settlements, which is the oldest and probably one of the most powerful institutions, financial institutions on the earth. And of course, we have the World Trade Organization that is there to incentivize international trade. And of course, we have the United Nations Organization. Now, you might notice that most of these organizations were developed and put in place after World War II at the Bretton Woods 1944 conference. So at the Bretton Woods 1944 conference, the main institutions created were, of course, the International Monetary Fund and the World Bank. The Bank for International Settlements is older than these two institutions. It was created in the 1930s, and originally it was designed to manage reparation payments from Germany to the Allied nations under the Treaty of Versailles. But when the debt was forgiven, it became a financial institution in and of itself. Now, the Bank for International Settlements is an extremely peculiar institution, and I'll get into this in another lecture, because its customers are central banks. So the Bank for International Settlements is a bank only for central banks. It also makes many rules and regulations that govern the commercial banking industry. So even if you haven't heard of this organization called the Bank for International Settlements, it's extremely important, and it coordinates its works with the IMF, the World Bank, the Financial Stability Institute, and others. It's extremely important. SWIFT was established much later in 1973, but SWIFT is extremely important because it standardizes messages that banks use to communicate with each other to enable payments from one geographic area to another geographic area. So if you are cut off from this SWIFT system, as Russia and other countries now are, it is very difficult to make cross-border payments, especially in the hard currencies, the dollar, the euro, the British pound, the yen, the Swiss franc, and the renminbi. These are the main global reserve currencies. The actual payments, international payments, are made through the correspondent banking system or some other way to clear and settle payments between banks in different jurisdictions. It has nothing to do with SWIFT. So SWIFT is not an entity that takes care of accounting ledgers. It has nothing to do with the debit and credit of accounts that enable the transfer of funds from one geographic location to another geographic location. But SWIFT has standardized the protocols that are necessary for banks to use to send instructions from one bank to another, or even, for example, if you initiate an international transfer, your initial order to your bank is actually going to be in the format of a SWIFT protocol. And then when your bank receives that message, it will use another protocol from SWIFT, and it will send it to a correspondent bank in order to facilitate the transfer of money from one location to the other that originated from your order. So SWIFT is a very important institution, and we will discuss it in more detail later. I bring in the World Trade Organization because it was another organization that was immediately created after World War II. But of course, they couldn't get agreement on an entity. So what we ended up with was GATT 1944. But GATT 1944 had its own secretariat, which was located in Switzerland. And it played a very important role. And as I said, the role of the World Trade Organization that was formally constituted in 1995 is to facilitate trade and also to provide a forum for settlement of trade disputes. And the idea behind the WTO is to incentivize the lowering of tariffs so that it promotes international trade. Of course, now we're in a completely different environment where we're beginning to return to nationalism and higher tariffs for political and economic reasons. But these basically run contrary to the original mission of the GATT 1944 and as replaced by the WTO in 1995. The United Nations is a political organization, but what we cannot forget is that financial institutions are political. So never forget this. The entire system, the economic project, is a political project. So we have the infrastructure layer, which I've just explained. On top of this layer, and this is my model, this is not based on any sort of empirical data, but it gives you a way to think and organize your thoughts around this topic of international banking. And here we would have governments, the central bank, which is clearly important, and there's central banks all over the world, and commercial banks. And why do I include commercial banks? Because, as I said, they have the capacity to create money, and they work very closely with the central bank of any country. Then we think of the superstructure layer as simply all of those non-financial, non-bank financial institutions, such as pension funds, insurance funds, investment funds, hedge funds, sovereign investment funds, and all of the other ancillary services, the fintechs that you hear about, such as Revolut. These are all at the superstructure layer. So what we can see is that what we're going to try to show in this course is that the infrastructure layer is actually the one that sets in motion the overall policy for the development of financial services throughout the world. And the transmission mechanism is from the infrastructure through this interstitial layer of government, central bank, commercial bank, then through the superstructure, which involves all the other non-bank financial institutions and markets in which we make transactions today. And one of these markets, of course, is cryptocurrency market. So we will also talk about that in this course. The reason why I want to examine the financial statement of a major bank, let's say JP Morgan, is financial statements are the best way to understand any juridical organization, a company, a bank, it doesn't matter what it is. The financial statements are critical. So we will look at the financial statements, and from these financial statements, we are going to be able to deduce the activities of the bank. We may also be able to assess the financial health of the bank, and we will also see, which is very important, its capital structure. The capital structure is important because a bank needs a certain percentage of capital relative to its liabilities in the event of losses. So capital should be the first layer of absorption of losses. Otherwise, the bank is going to fail. So we will also look at this aspect of banking requirements, because one of the rules governing banks is that they must have a sufficient amount of capital relative to their risk-weighted assets. So we will talk about that also. So I'm going to end there for right now because, again, I realize that attention spans are limited, that you only can absorb a certain amount of information. And after I post this video, I will also provide a assignment sheet so that I can assess whether or not you have taken from this very, very short lecture some of the main points that I would like you to have learned, and I can then have a basis to assess the level of your learning. So thank you for this first lecture, and as I said, I will be posting lectures regularly till the completion of the course. And I also will provide a document that provides an outline of what you should read. I've got a lot of PowerPoints on the RISEBA website, and I will give you direction as to which ones to look at and prepare for a lecture. Of course, I will provide my email so that any questions you may have, you can ask me and I will answer them. So at this point, I will say goodbye, and I look forward to seeing you next time. Thank you very much.